Good morning, and thank you all very much for joining us this morning. My name is Steve McMenamin, and I'm your host for today's event, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, after the fall, picking up the mortgage pieces, is a continuation of Ted Seides' original session in May of 2007 that was titled Mortgages, End of the Beginning or Beginning of the End. We all know now that it was the end of the beginning, but today we're here with a sense that this may be, in fact, the beginning of the end. And as is our custom, we've persuaded the best athletes from across the disciplines to share their insights with us. I will introduce them briefly after I say this. The speakers' views are their own and don't necessarily represent the views of the roundtable. So with that, Josh Birnbaum is the Chief Investment Officer of Tilden Park Capital Management, a New York-based hedge fund that focuses on credit and asset-backed strategies. Before founding Tilden Park in 2008, Josh was a fixed income prop trader at Goldman Sachs, focusing on mortgage backs and derivatives. For those of you who don't recognize the name, this is the fellow who first bet against Bear Stearns' rosy outlook on mortgages. He then took positions against subprime, a position that Goldman's senior management later adopted on a bigger scale. Donald Brownstein is CEO and Chief Investment Officer of Structured Portfolio Management, a Stanford-based hedge fund that focuses on credit and relative value strategies in the U.S. mortgage markets. Before starting SPM in 1997, he founded CDC Servicing, a specialized subsidiary of Kestapo. In the late 1980s, he worked in portfolio management at Franklin Savings Association in Ottawa, Kansas. And before that, Don was a professor of philosophy departments at the University of Kansas and the University of Texas. And finally, Greg Littman is the Chief Investment Officer of LibreMax, a New York-based hedge fund with $1.5 billion of assets under management. Greg co-founded LibreMax with Fred Betschneider in 2010 to concentrate on credit strategies with a bottoms-up fundamental focus. Mr. Littman's 15 minutes occurred when he was written up in 2 books. Michael Lewis's The Big Short and Greg Zuckerman's The Greatest Trade Ever, claiming that he made $2 billion by shorting subprime mortgage debt. Before that, Greg was a successful risk trader at Deutsche Bank and the head of all exotic, those are my words, credit trading at that firm. And finally, Brian Furtado is a moderator of the Greenwich Roundtable today. Brian runs the private investor practice, the family office group at BlackRock. He's a trustee of the Roundtable and a member of our programming committee, so please welcome Brian as he sets us up for today's discussion. Brian?
Terrific. Well, thank you, Steve. And it's a real pleasure to be here this morning with you all. And I have to say, I was just saying to Steve, I think that this is some of the best artwork I think we've seen since we've been here, definitely the most colorful. I think it sets the stage well. We're going to have a really interesting conversation today on mortgages. And mortgages have obviously been central to the investment discussion for all of us, I think, as allocators over the last 5 to 6 years. So I think it's fascinating from the perspective of making money, but also in the sense of what's happening in the broader markets, what's happening in the housing markets, et cetera, and what's happening on the political landscape. So there's just a number of aspects here that I think are really interesting to us all as allocators. It remains the case today that these are all incredibly important aspects. I think, just to give you a sense of a couple of the highlights in this market that have been going on, obviously, the ABX market traded before 2007 up in the 80 sort of range. It went down in the middle of the crisis down into something like the 20s, and obviously our experts here are going to expand on all of this. But and it's rebounded somewhat, but I think right now maybe into the sort of 40-ish type of a range. And we'll get into that. We'll get into the concept of, is the ABX even a great index to even look at? But just to give you a sense of it, obviously Case-Shiller as well, very closely followed in terms of the housing markets. Has some markets around the country in the US bottoming out, and in other markets we're not close to that. So, there's a lot of volatility there as well. So you add to that the political risk that's going on right now in these markets, and it's a really interesting cocktail. And I think it opens up some really interesting, ripe investment opportunities as well. So we'll be delving into a lot of that. I think we're really fortunate to have 3 of the best athletes, as Steve said, in the marketplace today, which is just fantastic to get into these markets. And I think as we always do, they're going to talk about the opportunity set that they see in the marketplace, but they're also going to talk, and I've asked them to because I think this area can get a little arcane and it can get a little bit esoteric. They're going to get into a little bit of their strategies and what exactly that is that they do. And I think what you'll find is that there is a lot of nuances and differences, and they focus in different areas here. So I think it's a great setup on the panel. But before I hand it over to Josh to really set the stage here at the outset, I also want to say from an allocator's perspective, I think, and this is probably self-evident to all the folks in this room, that this has been a tremendously successful space. These individuals have been successful, and if you look across all hedge funds, they have been some of the real leaders, if not the leaders in the business in the last 4 to 5 years, and it continues again this year. So you've got great performance coming out of these managers, and in this sector as a whole, anywhere from 6 to 12% type of range of returns again this year. So again, obviously, the most important question is where do we go from here? But certainly an area that it's sort of hard to ignore for sure. So with that, I'm going to have some questions for each of the speakers as we go through, and then we'll have time for questions at the end as well. But let's kick off with Josh to begin with.
Thanks, Brian. Good morning, everyone. So I imagine many of you are here because you're interested in distressed mortgage investing or mortgages in general. But I also imagine that many of you would like to hear some of our views on the housing market. And lastly, given the pivotal role, as Brian was saying, that mortgages and mortgage credit played in the last crisis, I imagine many of you would like to hear some of our macro views going forward. So today I'm going to touch on all three of those things. By way of background, Tilden Park is a fixed-income multi-strat. We primarily, the last few years, have been focused on the RMBS market, the non-agency RMBS market. It's pretty amazing to think about how far this market has come, mortgages without government backing in the last 4 years. It was almost 4 years ago that Hank Paulson was begging for a $700 billion check to go out and buy all of these assets because it was perceived that the government was really the only game in town. At this point, you fast forward to today and you've got a market with broad investor participation, with really an increasing share of participants coming from the alternative investment community, both hedge funds and private equity. I think many of you know already that this is a market that's had some very good years since the crisis, and one notable bad year last year. But if you take a kind of a broader step back and think about how has the performance of this asset class performed versus other things since the crisis, this is an asset class, at least the credit side, that has vastly underperformed other risk assets. If you rewind the clock and you go back to February of 2008, the month before Bear Stearns went down, the S&Ps were basically trading at the same level as today, around 1350. So we've round-tripped in stocks. Investment grade and high-yield corporate credit is trading actually materially tighter today than we were in early 2008 before Bear went down. And yet, when you look at this asset class, if you talk about RMBS for a second, the prices in the RMBS market on average are trading at a 40 to 50% discount to where they were back then. Most RMBS bonds that were originally rated AAA in February of 2008 were trading close to par. Today, those same bonds trade around in the 50s on average. There's lots of dispersion around that, but there's been a huge underperformance in price terms in this space versus other things. So, that's prices, but the question is, what does this really represent a big opportunity? And, there's a lot of yieldy bonds in the RMBS market, but one of the ways that we like to think about valuations is to think about what kind of economic scenarios are priced into these bonds. And one of the key economic factors is house prices, at least on the RMBS side. And when we look at the bonds and the way people are running bonds today in the RMBS market, the sort of the baseline scenario for most folks is a pretty bad number, maybe down at least 10% in home prices as a kind of just a starting baseline. But then when you think about how these bonds stress, a lot of the bonds that I come across are essentially pricing in like a 1/3 to maybe even a 1/2 chance of another huge drop in housing. at least 25% drop in housing from here. To us, this is a kind of a total disconnect relative to what's going on in housing today on the ground, as well as when you look at what's priced into the equity market in terms of names that are exposed to the housing market. So what is going on in housing? I mean, there's been a number of false dawns since the crisis in housing, only to have people be disappointed. But what we're seeing the last quarter in housing is pretty constructive, at least in terms of prices. I mean, the rate of appreciation in some of these markets, especially markets dominated by investors and cash-only buyers, has been pretty dramatic. It's the rate of appreciation that we haven't seen since 2004 and 2005. And before we get all excited about this, that we're out of the woods, though, keep in mind, I think most of you know, that in a number of these markets, supply has been constrained, and it's been constrained by really two factors. One, you got a ton of upside-down borrowers. By most estimates, 20 to 30% of the United States is upside down. These folks are either unwilling or unable to sell their homes, so they're keeping their homes off the market. And then we've all heard about these foreclosure backlogs, where there's huge shadow supply that is yet to hit the market. Most estimates put that number between 7 and 9 million in terms of current defaults and future defaults that haven't yet happened, that's supply that this market needs to deal with. So the question is, how do we evaluate that in the context of our views on housing? And what we try to do is we try to look at kind of a big picture approach and say, almost like a balance sheet approach. If you take on the left side of the balance sheet, you look at the total number of housing units in the United States right now, and you include all that shadow inventory. And on the right side of the balance sheet, you look at the number of households that are there to potentially consume that housing. Right now, in terms of looking at that relative to long-term equilibrium, there's about a 2% premium in housing units relative to kind of a normal condition. And if you look at reasonable rates of construction as well as household formation over the next few years, it's only going to take about 2 to 4 years to work that off. So from that standpoint, it's actually a fairly manageable situation. And step two is we look at prices and we look at incomes. Price-to-income ratios for housing right now are running at 30-year lows. So when we take our balance sheet and we take the prices and multiply it by the number of housing units, and on the right side of the balance sheet, we take incomes and multiply it by the number of households, we get the aggregate value of the housing stock relative to the amount of income in the United States or an MSA or a state. We can do this at multiple levels to consume that housing stock. And on that metric, housing looks to be about 5 to 10% cheap based on long-run valuations. And we're ignoring the bubble years when we do this. And third, we look at the impact of the mortgage market. Mortgages right now, at least headline rates, are at virtual all-time lows. But the counterbalance to that is that we're at multi-decade lows in terms of credit availability. So we have to have some way of managing that conflict. And we've done a lot of work on this, looking at the changes in down payments that are required now, the changes in the mortgage types that are available to people, as well as the pretty dramatic changes in underwriting standards now versus in the past. And when we add it all together, we get a market, a mortgage market, a mortgage environment that we think is actually more stimulative and more accommodative than any time in the last 20 years. So really 3 different metrics cumulatively telling us that housing is relatively cheap right now. There's actually, in a number of these markets, pretty good chance for some nice upside. And more importantly, potentially, as it relates to mortgage credit, the likelihood of a housing double dip from here, absent some exogenous event, is actually pretty low. So when we come back to the RMBS bonds that we're looking at, this is really the fundamental reason why, one of the reasons why we find this space so attractive, because these bonds are pricing in still a very high probability of an Armageddon in housing, and yet when we do our housing analysis, econometrically, housing looks to be in pretty good shape, or at least on the mend. So that's all well and good, but the question is, there's a lot of other things that go into evaluating these investments, a lot of other risks. And one of the questions, what could we be missing? Well, I'm going to talk about some of those risks. Whenever I think of risks, I like to think of, what worries me in terms of these risks. And a lot of times when I'm thinking about risks, I like to put them into one of three categories. Number one, is this a risk that is hard to measure? Is it something that evaluating is very challenging? Number two, even if I can evaluate and I can measure it, if I want to hedge it and there's no hedge instrument out there, or I can't diversify it away, that's a concern. And number three, maybe there is a hedge instrument, but to go and hedge the strategy is so expensive because by engaging in the strategy, I'm short options. So it's a very expensive proposition. So I'm always thinking of risks in this context. So take housing as an example. Well, while it's challenging, you can come up with a mapping for the sensitivity of a lot of these bonds to housing scenarios. And you can also go out there and you can choose to hedge this housing risk. You can hedge it within the mortgage credit market, and you can also, with some basis risk, decide to go out and hedge it with equities and some other stuff out there. So it's measurable and it's hedgeable. And thirdly, I don't feel that at these levels on these bonds, on these credit bonds, that I'm short options by engaging in the strategy. If anything, these bonds trade more like there's an embedded call option that is frankly undervalued when it comes to housing. If you turn to another risk, you can't really discuss a fixed income strategy without talking about interest rates. So talking about interest rates in terms of my three things, first of all, evaluating the interest rate exposure of these bonds when it comes to interest rates. It's more challenging than it is for some agency bonds. It's more challenging than it certainly is for corporate credit and treasuries, but it's doable. And it's also, there's lots of different hedge instruments out there that you can use to hedge rate exposure. So for us, that actually isn't a big concern. And then thirdly, thinking about one of the risks that people think about in mortgages is convexity or negative convexity. At these types of dollar prices, most of these distressed mortgage credit bonds are not short any measurable amount of interest rate convexity. So that's something that we like. Another risk that we think about is just the economy. General economic conditions. Obviously the state of the economy, the state of employment is going to affect a borrower's ability and their willingness to keep paying their mortgage. And, there's been massive improvement in borrower behavior since the peak of the crisis, especially in some of the more distressed sectors. But one of the things we like to think about is what if that reverses? What if we get some sort of exogenous event that causes credit behavior in the United States to get much worse? To try to measure that, what we do is we have what we call our Lehman Brothers scenario. And what we do is we go back to the fourth quarter of 2008 when credit behavior was at some of its worst, in the last 20 years. We look at how borrowers were performing, or not performing really, and we replicate that behavior for the life of the underlying mortgage pools. And when we're looking at an investment, if the bonds don't stress well under that condition, then we generally pass. So for us, it's measurable. And then if you look at, is it hedgeable? Well, we view that as kind of a macroeconomic condition, so it's actually something that you can go out and you can trade risk assets against that, and it's actually pretty straightforward to be able to go and hedge that. It's not that expensive. Moving on to another risk everybody knows about, servicers. There's a lot of these pools have more than 50% of the underlying mortgages are delinquent. And what that means is that the role of the servicer is much greater than it was in the past. The servicer is a key actor in a bond investor's outcome. And this is a very challenging part of investing in this space. Many investors simply shun certain subsectors because they say, I can't get comfortable with this. There's just too much servicing risk. I don't know what the servicers are going to do. And the servicers can do a lot of different things. they can modify these loans, they can change the types of modifications, they can decide to stop advancing on delinquent principal and interest, they can change the way that they interface with borrowers. There can be a transfer of servicing from one servicer to another with very different behavioral practices. So these are all things, servicer can decide, do I short sale guy, foreclosure, REO. These are all things that are very impactful on bond investors. But we actually think that this is one of the biggest opportunities in this space. If you know what you're doing, and it comes down to really being able to put some boundaries around servicer behavior. And putting boundaries around that behavior comes down to really three things. Lots of data, having the technology to analyze that data, and then having the judgment to know, how do I come up with reasonable boundaries of scenarios and try to get comfortable with the servicer risk on certain bonds. Now, regarding my second criteria, is servicing risk hedgeable? Well, it's partially hedgeable. There are bonds that like certain types of servicer behavior, and there's bonds that don't like certain types of servicer behavior. So you can actually pair those bonds against each other in a portfolio to some extent. You can also diversify away a lot of the idiosyncratic servicer risk. Right now in our portfolio, we have more than 200 different names. We track how much concentration we have in individual servicers. This is a very important element. So you can diversify away a lot of this individual risk. Now, the government is a huge part of the mortgage market, and perhaps more so I think definitely more so on the agency side than the non-agency side. I was talking earlier about how involved the government was, potentially involved in this market 4 years ago, in that TARP moment, and then you think about back then these very assets were viewed as really central to causing the financial crisis and central to what would ultimately affect the economy's outcome. Now these assets are viewed differently. They're viewed as more of a kind of a reflection of the economic conditions around them, and that cause versus effect is critical, because it means that the government now feels far less compelled to intervene in the non-agency market. And that makes the job of an investor a lot easier. In terms of putting numbers around this, you think about where the government's been much more focused has been on the agency side and program with like refinancing programs like HARP that have been been getting a lot of attention lately. So the question is, we've got the government, we've got these other fundamental factors. If we can get comfortable with the bond fundamentally, well, what about the role of market technicals? Because fundamentals are one thing, but bonds can trade however they want to trade based on the behavior of other investors. So this is an area that, to us, is critical in being successful in this space. I think maybe more than any other market of its scale in the world, the investor base in mortgage credit has changed dramatically over the past decade. It used to be that you had a market, the buyer base was dominated by a lot of CDO buyers. Money managers, insurance companies have come back to this market, but Wall Street CDOs are dramatically smaller than they were 5 to 7 years ago. A lot of these guys have been replaced by hedge funds and private equity, and then some mortgage REITs have come in and are getting pretty big in this stuff also. So the good news to all this is that some of these newer players, most of these newer players, have more permanent capital, more stable capital, less levered, and they're more patient. But the bad news, potentially bad news at least, is that a lot of these new players they have they basically have a broader platform. And sometimes it's not a core competency for them trading these bonds. And when macro moves around, sometimes these guys will trade mortgage credit, both RMBS and CMBS, like it's an emerging market bond or like it's commodities or like it's stocks. It means that sometimes the space can be more correlated than it should be to the underlying fundamentals. So that's one of the reasons why we get pretty deep into macro. We think a lot about how these other investors are going to be behaving and how it's going to affect our portfolio. So I'll just touch on macro for a second. I know I don't have a lot of time, but our macro views right now are really premised on three things. Number one, that the next financial crisis could very well be worse than the last one. But most importantly, number two, the next financial crisis is unlikely to be led by the mortgage market or the housing market. And number three, it's very hard to call the timing of the next crisis. I mean, the ability to kick the can down the road for a long time, Japan's done that for decades, and we seem to be doing that, at least so far, successfully in Europe, but we'll see. So we kind of have a bimodal view of things right now. We think, scenario one is we muddle along in a low-growth, constrained, basically economy that you've got global deleveraging going on at the same time where central banks are trying to counterbalance that with massive balance sheet growth as well as some occasional fiscal stimulus. And right now these are kind of balancing each other in a low volatility environment. The other scenario is a darker scenario where central banks and governments are already stretched and we get something unexpected that causes them to not be able to bail us out, and we head into a much darker scenario. Given that we haven't addressed a lot of the core problems from the last crisis, we could head into a darker scenario if that happens. So our mortgage strategy actually, we think, fits pretty well in this bimodal view of the economy or macro, because if you take the first scenario, most of what we're buying, we consider them pretty stable fixed income assets that have a lot of current income and will perform well in either scenario. And then we take some of that income and we go out and we look globally across the landscape and try to find long-dated, cheap tail hedges that should perform if we experience that darker scenario. So before I end, I'll just leave you with a little bit of a lighter story. In 2007, as the mortgage bond market was unraveling, I think it was in the spring, I overheard a story of a mortgage bond salesman who had to deliver some bad news to his client. At that point, prices were really starting to drop precipitously, and the bond salesman calls up the client and says, "Sir, I have your marks for this month." The client says, "Okay, so give it to me." He goes, "Would you like the good news first or the bad news first?" The client says, "I guess I'll take the bad news first." He goes, "Well, the mark on your bond last month was 90. The mark this month, after careful consideration, is 20. And then the client goes, not expecting this, goes absolutely ballistic. After calming down, says, "What the fuck is the good news?" And the salesperson says, "It's all upside from here." So I leave you with that because I can't sit here and tell you that this is a market that's trading at its absolute lows. But what I can tell you is if, compared to back then, there's a lot of money good bonds today in the RMBS market that are trading at much lower prices than when that story occurred.
That's great. Thank you, Josh. That's a great start. I think just before we move over to Don really quickly, on the risks, I think you touched on a bunch of those. Talk about the European banks and is there a lot of supply that could potentially come on from the European banks, and then other things like Maiden Lane? Does that affect your markets as well?
Yes and yes. The single largest holder of RMBS in the world are foreign banks. So people, especially last year, were looking at that and handicapping these guys. They head into a darker scenario. These guys might have to sell a lot of bonds, and market already saw what happened with Maiden Lane in 2011. Maiden Lane in 2011 pummeled the RMBS market. Basically, the street took down a lot of paper, got over its skis, and wasn't able to redistribute stuff. Macro took over, and then a lot of regulatory pressure. Ultimately, the street ended up getting killed on this trade. And the European concerns, while there were some large-scale portfolio sales out of Dexia and Commerzbank, we didn't see those fears materialize. And, part of it is, Europe's been given a continual lifeline by the ECB. A lot of these banks, as we know, with many distressed assets, banks are very reluctant to sell stuff if they don't have to. And the way it's generally worked at a lot of these banks is, with a few of those large portfolio exceptions, they set up these workout groups. They got a few traders in a room. And they tell these guys, you know what, over the next 5 years, we want you to take the portfolio, down from X to Y. And these guys, they even sometimes even buy bonds, which is totally bizarre. But it's really been a small trickle. And actually for us, that's been supportive of our business model because, we're not here to compete with, $10, $20 billion, hedge funds and private equity to buy the Dexia portfolio. It's much easier for us to sit here, forge a relationship with these groups, and basically buy this trickle of stuff that's been coming out of Europe. So it's actually been much less than people fear. And if I had to handicap it, I think these will be some of the last assets that you'll see, coming out of the European banks. But it's obviously a consideration. When we look at, tying back to macro, one of the ways that we actually hedge this scenario is we went short the euro at the end of last year. And, that actually was helpful. It wasn't a huge part of what we do, but we did view it as enough of a risk factor that we took that position thinking there was some probability these guys sell more.
Great. Excellent. Thanks. Let's move to Don.
Is there a question? Let me tell you a little bit about structured portfolio management and what we do. We're probably best known for our investing in mortgage-backed securities, which I assume is why I'm on this panel. But in fact, I've told investors for many years that while we are in the mortgage market, we are not of the mortgage market. We don't think, or at least I don't think, of what we do as purely investing in an asset class. I think of it as, I think of the mortgage market, or mortgages in the United States, as essentially providing us with a very elaborate toolkit, which we can use in all kinds of ways in order to take positions relative to this, that, or the other thing. For example, our oldest fund, which is called SSH, and we're in our 15th year now, is exclusively in the non-agency sector. This was when we started when the non-agency sector did not mean subprime and Alt-A mortgages. It meant mortgages on houses like the ones around here, jumbo mortgages with very high credit quality and just peculiar characteristics, both with respect to the mortgagors and with respect to the particulars of the mortgages. So what we were interested in that market was the fact that when it came to the exercise of prepayment options, the option that you have to pay your loan off, in most cases, for most American mortgagors, you can pay your loan off early without paying a penalty. And while the market had come in those days to regard that option as an option that was struck on relative interest rates, that is to say, if you had a 6% loan and you could get a 5% loan, you had an incentive to refinance, so you would pay off your old loan and take out a new loan. And the idea was that people were exercising their option to prepay, basically dependent upon where they stood relative to the current interest rate environment. We thought that there were very notable differences in the way non-agency loans prepaid from the way in which agency loans prepaid, Fannie Mae and Freddie Mac loans prepaid. And in particular, we were concerned about, we were interested in the question of why it was so much more difficult to predict the behaviors of non-agency mortgagors than it was of agency mortgagors. So we investigated why that was, and developed a theory of it. And we also developed a theory about the relative ways we could go about hedging the risks associated with the greater heterogeneity in the non-agency market sector. And we set out to buy non-agency mortgage positions which exposed us to prepayments. And the bonds we came to be known for owning are called IOs, or interest-only securities, and they are effectively like the short option position, the written option position, relative to the prepayment option. And as somebody, I think it was on the Saturday Night Live show years ago, used to say, they've been very good to us. So we've been prospering for a long time on the basis of understanding why non-agency mortgagors tend to exercise their prepayment options less regularly than agency mortgagors. It seems like a minor point, but in fact it depends upon some, what I regard as fairly deep insights into the way the mortgage market is structured and the way people actually behave, as opposed to the way you might have been taught in your finance courses how they're supposed to behave. We don't think of people as economic automaton. We think of them as people. And by the way, as I sat down here at the beginning, I said, we were talking about all the people in the room and how they're all LPs, and I said I didn't realize that LPs were people. Apparently, it's part of the Supreme Court's Citizen United decision. LPs are now people. Anyway, we have a number of other funds in greater or lesser degree. Most of them have connections to the mortgage market. We have a fund which invests exclusively in the agency sector. And we have another fund which invests exclusively in the agency sector, but is directional with respect to prepayments. We have another fund, we had another fund which shorted the subprime sector in 2007. And by the way, that joke you told at the end where the guy says it's all upside from here, we sold out at 11. So I guess it wasn't all upside from 20. The idea of using entering the subprime short in 2007, by the way, our timing was perfect because our lawyers couldn't get our documents done in time for us to open when we wanted to open. So we opened in February of 2007. But we also saw that the consequences of the collapse in the subprime sector and what we thought was likely to be the collapse in the so-called Alt-A sector, which by then had come to represent about 25% of all mortgage originations, where perhaps 5 years before they had represented about 3.5%. So huge growth in mortgage originations in subprime and Alt-A. What had happened, we felt that when that market blew up, as it was doing, there would be an enormous spike brought on by the exposure of banks to this mortgage sector. There would be an enormous spike in rate volatility, effectively a spike produced by what ended up being the financial panic. And so we opened a fund which took advantage of that. We had a fund based on U.S. vols. But you see, it all comes out of the mortgage market, and the reason it comes out of the mortgage market is because the mortgage market in the United States is such a huge market, it affects everything. We have funds that are exposed to a variety of other things, rates. We've done some corporate debt. We've had a fund which, it wasn't a fund, it was a part of a fund which took positions relative to corporate debt and corporate liquidity positions. So we found, for example, that after the collapse of 2008, there were a lot of very, very bad corporations that were very bad at their business, which had, as a result of being very bad at their business in the period leading up to 2008, had managed to accumulate large amounts of cash, which they didn't know what to do with, and they were loath to return it to their investors. So they were sitting there on cash, and they also had outstanding debt. In many cases, it was callable debt. So we felt, what the heck, let's buy some of that debt, because they'd have to be even stupider than they were to lose all the cash they had before they called out the debt. And turned out that was a pretty good idea as well. Right now, one of the things we're doing is we have a fund which is a play on U.S. rate policy, the Fed, in other words. And this, I'll tell you the story behind this thing. What happened was I was in Switzerland talking to an investor a couple of years ago, and the investor asked me out of the blue, do you think, are you guys going to, and he meant by us guys, he meant the United States, in particular the Treasury, although I had no particular role in the Treasury, and nor do I intend to. But he was asking us whether we intended to pay back China. And I thought for a second, I said, would you? And, that led us to think about, well, we're not going to pay back China, at least not in real terms. Maybe we'll pay them back nominally, but why in God's name would we pay them back in real terms? After all, we have all the TVs and the T-shirts and all the other stuff, and they have pieces of paper that say, this is legal tender for all debts, public and private. Well, we got the TVs, they got the paper. Why are we going to pay them back? So my feeling was that we wouldn't be paying them back. And then the question that would be then how to invest in such a way that you recognize the likely outcome, which is to say we think that at the end of the day we'll see a fairly dramatic spike in rates. In the meantime, the easy way to get around that, to take advantage of that, would be to short, let's say, the 10-year note. Or take some option position, which was effectively equivalent to it. So you short the 10-year note, and then you're sitting around waiting for the Fed to decide that the sun is coming out and the land is drying up, and we can go forth and multiply across the land again. But that could take a long time. Noah was on the ark for some time, and I have a suspicion that we're going to be on our own ark for an even longer period. In any event, we looked into our mortgage toolkit, and we found instruments which have negative duration, which is to say they would respond in a way in which a short 10-year or 5-year position would respond to a rate move. However, they also have positive carry. So while you're sitting around waiting for the dove to come back with the twig indicating that land has reappeared, you're collecting a payment. And then it's possible in this fund, once it's clear that land is near, to change the position around in such a way that you have maximal exposure to rising interest rates. And it's relatively easy to do that. So there's another fund which employs mortgages as a tool. It's not about mortgages. It's about a macro question, but it's also employing mortgages. And finally, we've been in the paper the last couple of days because of a letter I wrote to my investors. This is my allegedly, some of the people here know about my letter writing proclivities. This is supposed to be my quarterly letter for quarter one. It went out last week. Anyway, in it I talked about, as I've been talking about for some time, what we think of as likely changes in the U.S. housing market. And in particular, since Josh already mentioned this, I thought I'd say a little bit about it. The story in the newspaper got the whole thing completely screwed up. So please don't take that as an indication of anything we're really about to do. We didn't comment on it. We said we had nothing to say about it. One of our investors apparently decided that he would release my letter to somebody or other who put it on Bloomberg and somewhere else. Anyway, in this case, what I was trying to describe was a change which I think is taking place now and which will continue to take place in the housing market in the United States. And by way of background, I'm old enough so I can remember a time when we didn't all live like this. Life was very different when I was born in 1944. Things started changing dramatically after the Second World War. At the end of the Second World War, we were in a position nationally in which basically there had already begun in the 20th century, in the 20s, a migration to cities, particularly from the South. There was also, and so, for example, Detroit, Chicago enjoyed tremendous population booms as a result of migration up out of the South. There was also migration into the West, continued migration into the West, but cities began forming in the West. Now, if you look at the way in which people lived in cities on the East Coast, in the North, Chicago, Detroit, and so forth, and in the beginning of cities in the Southwest and the West, you'd have noticed that most people tended to rent the houses, be they apartments or whatever, that they occupied. Rental was a typical mode of occupancy for city dwellers. On the other hand, in rural America and in small towns, the mode of occupancy was ownership. People owned, by default almost, the farm they lived on, or they owned the house they lived on in town if they were the town grocer or the town hardware store owner. If they lived in Lawrence, Kansas, where I spent many years teaching at the University of Kansas, they tended to own their house if they were a professor, or if they were a small businessman, or if they worked in the Stokely Van Camp bean factory. They all tended to own their house. There were some rentals for students mostly, but people tended to own their own house. So at the end of the Second World War, rental and ownership by occupants were the two basic ways in which people managed to have a house, to have a roof over their head. After the war, another thing happened. Rural America's population began to decline dramatically. And cities, particularly in the Southwest, South, and to some extent again in the North, grew dramatically. However, in a very short period of time, it became clear that the growth in the cities was growth outward, which is to say suburbs. And it was at that moment an open question whether or not the mode of occupancy from cities, namely rentalship, or the mode of occupancy from small town and rural America, namely ownership by the occupant, would come to dominate the suburbs. The first cases of this, like Levittown, Long Island, and in Pennsylvania, were very, very low-cost housing. I remember when one of my neighbors, I lived in an apartment building with my folks in the Bronx, one of my neighbors, the kids were my friends, moved out to Levittown. Their father worked at an airplane plant on Long Island. Imagine that, there were airplane plants in those days in western Long Island. And this was before the Long Island Expressway existed. They moved to Long Island, to Levittown, and they bought a two-bedroom house. I think the whole thing cost them about $2,000. And they had to put down $500, which was a struggle. At that time, my folks were paying $36 a month for rent. So this is a while back. Anyway, if there's a $2,000 house that you're buying, it surely was within the realm of possibility that that house would not have been bought, it would have been built to rent. So it was an open question whether the so-called American dream of home ownership by the occupant would be the emerging model, or whether rentership by the occupant and some form of corporate ownership would be the model. It turned out, as we all know, that the American dream was buy your home, live in the suburbs, mow your lawn, raise your kids, blah, 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 blah. The whole story. And that worked for quite some time. And then in 2006, housing prices began to descend after about 60 years on a national average of continuously increasing. So the surprise of 2006 was, I guess the way I've described this in the past is that we could actually run out of people before we ran out of houses. And indeed, that's exactly what happened. We ran out of people who could possibly afford to buy houses, and like Wile E. Coyote going over the cliff, we kept on running through the open air. And then we looked down, and, well, you know the rest. So now we have about 4.5 million houses that used to be owned by their occupants, which are no longer owned by their occupants because the rate of ownership, single-family home ownership by occupants per household has dropped to from about 70%, just under 70%, to around 65% now. And if it continues to go down, I think it's likely to go down more in line with what we see in some parts of Europe, perhaps down to 55%. If that happens, we'd have another 9 million or so houses that were formerly owned by their occupants but now are available for rental. And the question is, how will that rental take place? I believe, and this was the real point of my letter, that down the road there will emerge a market just like the market for mortgage-backed securities, but this will be a market for house-backed or lease-backed securities, which is to say, if you had 15 million houses at the average price that's now out there, there's no possible way for private investors, hedge funds, even Ray Dalio can't do it, to finance the whole thing. We're talking about somewhere between $2 and $3 trillion of capital that would be needed to pick up the equity position in these 15 million houses. That being the case, there's only one possible solution, and that is the capital markets. And the way that the capital markets work nowadays would be through securitization. So I look to the recovery of the housing market, not just in terms of housing prices going up, perhaps with inflation, perhaps a little bit more, or remaining stable. I regard it as being something which will occur primarily as a result of the securitization of housing. It's the last big part of America that has not been corporatized. And yet it's a multi-trillion-dollar market owned by moms and pops and the banks that lent them the money and ultimately the security holders that bought the loans from those banks. So that's my position relative to future directions. And I think you can see from it, I'm tying it up now, how what we do at Structured Portfolio Management is, yes, indeed, we use mortgages and we think about mortgages a lot. But underlying the whole thing is a picture of what some people like to call, macroeconomics. I tend to cower in a corner when I hear that phrase because it usually just means some very general, out-of-date views about the way economies are supposed to work rather than how they actually do work. But thank you very much.
Great. Thanks, Don. And I want to come back to you on models and how they may have changed over the years because I know you use those a lot. But I want to go to Greg first, and let's talk with Greg. So, Greg, why don't you give us your views on the market, where we've come from? Obviously, you were a central role in things over the last few years, and would love to hear your views now, given where we've come from.
Great, thank you. Well, it's difficult to go after two charismatic speakers who've given both extremely comprehensive presentations. It's hard to think of anything to really add because I think they both said quite wise things. LibraMax, and I agree with a lot of things both said. LibraMax is a fund that was started in towards the end of 2010. We're now 22 people, and we're probably more similar to Josh's fund than Don's, and we only have one fund as opposed to maybe a baker's dozen. And what we focus on, we define it, like I said, as securitized products credit hedge funds. So what that means to us is we buy securities, not loans. We don't buy agency mortgages. We just buy credit mortgages, and we hedge. So similar to Josh, we are concerned about macro events and how they can affect the pricing of our bonds. And we use a variety of hedges at times to help counteract that. We agree with the euro, being that to the extent that troubles come in Europe, I think the pace of selling of mortgage-backed securities out of European banks will increase. And so there's some sort of correlation, if you will, between the supply and the supply pushing down the short-term price of mortgages and issues out of Europe, and it's something that one needs to protect against. By credit hedge fund, we mean, in addition, or by securitized products, we buy not just mortgages, we also buy other receivables such as consumer ABS, CLOs, manufactured housing, CMBS. And we think that given the issues today in facing primarily the banks, the investment banks, there are often opportunities where banks are doing things that are for non-economic reasons. For example, needing to sell inventory because it's aged inventory. I don't know what that was, but excuse me. So where aged inventory forces them to sell bonds too cheaply, balance sheet constraints near quarter end force non-economic decisions to be made by people. We try to only make decisions based on pure economics and risk reward, and we're always eager to pounce upon things that people that are not doing that. As a result, we probably trade our portfolio more actively than certain other people, because we're looking to upgrade and trade not only within mortgages, but also across different collateral types, whether it's mortgages into CLOs or subprime into non-agency. Like Josh, we view the tremendous risk related to servicer behavior and governmental interference, the robo-signing scandal, moral suasion to give principal forgiveness, as opportunities to hedge those risks through portfolio construction. Namely, certain bonds benefit from certain government plans while struggling under other potential proposals, and other bonds have the opposite profile. So marrying these two bonds together and taking advantage of different people's views when pricing can diverge can create excellent optionality for the fund. That is overlaid by, and Josh I think touched on this also, what's really neat about the mortgage market is it is both a huge market but a very opaque market, in that billions of dollars trade a week, but rarely does the same security trade twice in the same week, and there's no place you can look to get it. So whereas the equity market, everybody knows where Microsoft stock is at a given moment, and you can think it's going to go up or go down, but you know exactly what the world believes it's worth at this time. The mortgage market pricing is not disseminated, and as a result, often people have vastly different opinions about what a bond is worth at the same time, which creates all kinds of opportunity for people to buy if you actually have the ability to see what other people view and to sort of speak after they've spoken about their opinion. The key to that is data and models, like people talked about. The data requirements in the mortgage market are substantial, and the expenses associated with acquiring them are considerable, and the result of that is that there is a relatively small number of people that can do mortgages effectively, because it costs a tremendous amount of money to buy the data, and you can't really run a mortgage hedge fund without several $100 million of AUM. It limits the number of people. You think about equities, one guy can start an equity hedge fund with a few $100,000 under management. He's reading Barron's every weekend. If he picks the right stocks, he has good returns, and eventually he's a $10 billion long-short equity fund. So there's dozens and dozens, if not hundreds, of people trying to do that. There are not dozens and dozens of people trying to suss out the best mortgage bonds, because it just costs too much money to do that, which results in there being a natural amount of alpha in the product that can be mined by people versus products that are more competitive. Where we see the most interest right now to us, is in subprime, and the reason that we have that view is when we look at the housing markets nationally, and this is the case almost in anywhere. And it was in our quarterly letter, but I'm not as accomplished as Don, and it wasn't written about everywhere. What we wrote in our most recent quarterly letter.
Be careful what you wish for.
I'm not wishing for it, so at all. I have more notoriety than I would like already. What we wrote about in the last quarterly, and we examined almost anywhere you look in this country, lower end homes. So as a percentage of the median for that place. So the median home in Southern California is very different than the median home in Tennessee. But what is true almost universally in this country is that lower end homes went down more in their neighborhood than the higher end homes did almost everywhere. In addition, low-rent homes have come up more from the bottom. In some places, low-rent homes are up 5 or 10% from the bottom, whereas high-rent homes are still going down. It intrigues us in that when you look at the subprime pools, borrowers have been significantly underwater for several years. Depending on the pool, it could be anywhere from 30 to 65% delinquent. So let's just call it 50% delinquent. So half the people are paying their mortgages. They are underwater. They've been underwater for 2 years. We believe that housing is sort of stabilized in the lower end and has actually started to go up, which I'll get into in a minute. But if you look at the higher end homes, in most cases, actually, the things have not gotten better. They didn't get as bad, but they've not gotten better recently. So we view the person in the higher end home, they've only recently become underwater. So the subprime borrower owes about 30 cents more than his house is worth, and that's been the case for a while now. And many of them are paying anyway. The prime borrower, in a lot of cases, only recently owes a little bit, and this is a result of he put more money down originally, and his house has gone down less. So it's only recently that he's become underwater. If housing goes down another 10% nationally, as an example, you would see the subprime borrower say, well, my house was worth, I owed 30 cents more than it was worth, and I paid. My house is worth 40 cents more than it's worth. I'll probably still pay. The ones that have been paying will still pay. The prime borrower, it's an entirely different situation. It's only recently gone underwater. Now it's a lot underwater versus what it was before. And in most cases, prime people, at least relative to subprime, have the ability to move. They have the ability to walk away from the house and rent 2 blocks away, or they have the ability to buy another house, the same house as theirs, but 2 blocks away and a lot cheaper. The subprime person doesn't have that ability. In most cases, they have enough perhaps to pay their mortgage, but they don't have any money in the bank for the future. So we view sort of the incidence, and Josh talked about things getting worse. If things get worse, we think that the increase in defaults relative to expectations, which are lower for good reason, the increase in defaults relative to expectations in prime will be far greater than the increase in defaults relative to expectations in subprime. That's also related to when you look at the pools. The typical subprime pool the last few years, prepayments have been virtually zero, defaults have been quite high. So the pools have from a credit perspective, the best borrowers in the subprime pool are trapped in these pools. They're paying, but they don't have enough money or the credit to get out of this mortgage, to refinance the mortgage or to move. The worst borrowers have already defaulted. Some of these deals have already experienced substantial losses. 20% or more of the pools have already been wiped away. Prime pools, it's the opposite. Prepayments have been relatively high. Defaults have been relatively low. So the best borrowers in the prime pools have refinanced. The worst borrowers are actually still in the pool. They've been able, in most cases, to stay current, but they're perhaps running out of time on their ability to do that. So when we look at the pools on a going forward basis, we feel that the prime pools are not poised to recover the way that subprime. You can see this also if you look at delinquency trends. Seasonally adjusted, the delinquency rate so far in 2012 for subprime is better than it was in 2011, which was better than 2010, which was better than 2009. Prime pools, while the delinquencies are lower than subprime, are continuing to inch up. So those deals are actually getting slightly worse at the same time that subprime appears to be turning the corner. Additionally, the subprime yields, because of a certain amount of aversion, there are some notable and quite accomplished investors who say they buy Alt-A, but they don't buy subprime. So the result of that is, in a lot of cases, subprime, the yields are roughly 100 basis points higher than prime, if not 200 basis points, for market standard assumptions, for assumptions that people would agree make sense. You can pick up a significant amount of yield for buying subprime versus prime. So we look at the last thing I would say, and this relates to, I agree with Don about the lease-backed securities is the future. There's a lot of ways they could be structured, perhaps something similar to the way franchise loans, which was a market that did blow up, but nevertheless, franchise loan securitizations were done. If you look at all of the anecdotal evidence, the current excitement in buying homes to rent in the U.S. is all lower-priced homes. There's a business today in buying low rent. You look at Colony Capital; they're talking about houses $150,000 average. That's a subprime house. There's a business today in buying low-end homes to rent, which means to me that low-end homes are trading at economic value. Higher end homes are trading because my kids are friends with the kids down the street, or my wife plays bridge with the ladies across the block, and I want to still live in this house, and I don't really care what the rental yield of my house is. I like living here. When you're buying a house to rent it out, you only care about economics. You don't care about the view. You don't care about the school district or how close you are to the playground. You just care about what's the rental yield. So why is this the case? One, we mentioned before, lots of defaults happening in subprime. So more market clearing events. When a market is forced to clear, it finds its economic value. When a market is not forced to clear, it's the same thing you're seeing, with the kicking the can in Europe. When a market is not forced to clear, it can stay sort of uneconomic for longer. In the case of prime, there's been fewer defaults and there's been fewer clearing events. I say also, it would seem that lower-end homes are more scalable than more similar. High-end homes, one guy has a pool, another guy has a tennis court. It's not the same. But you take houses that are $100,000 houses, there's less differentiation in them. It's easier to buy them in bulk and rent them out and manage them the same because they're more similar. So we view the sort of current zeal and interest in buying to rent as another thing buttressing low-end homes, because buying to rent is more feasible from a low-end home perspective. Again, I don't want to take up too much time before this ends, but to touch on a few other things. I think also Josh talked about, when the next crisis is coming and is it going to be housing, and I agree completely that it's far from clear that we're out of the woods, but also U.S. housing is not going to drag us into the next gigantic crisis. And in fact, I think actually we're entering a period where U.S. housing can do really well, housing-backed securities more specifically, can do really well in an environment where the economy does less well. If you think about the last few years, U.S. growth has been weak, but housing has been the weakest. Right? So GDP has been positive even while housing prices have been negative every year. Other economic data has been relatively good. It's been a muddle-through economy, but an economy where housing has been the weakest. If you look the last few months, that's not been the case. Industrial production, PMI, payrolls, GDP revisions, all of these things have begun to turn slightly weaker. FedEx recently announced, weak growth. There's been a variety, Bed Bath & Beyond yesterday. There's been a variety of sort of signposts that things are getting a little bit weaker from the economy. And at the same time that's happening, most, if not all, of the housing indicators have actually been slightly better. So while the last 3 or 4 years, housing has been the weakest part of the U.S. economy, I think it's very possible that the next 18 to 36 months, housing, while not being strong, will be sort of stronger than expected, or the strongest part of a muddling U.S. economy. And if that were to be the case, funds like ourselves and like Josh's that trade mortgages with a hedge, not PE funds that just buy mortgages, or some of the hedge funds that are really just PE funds in disguise, but funds that buy mortgages and short other things, could have sort of a golden time of it, which is that the mortgage market does better than our pessimistic assumptions, while other markets like equities and high yield, which are two of the things that we use as hedges, do worse than current sort of relatively optimistic assumptions. I think if you look at the mortgage market, most people who buy mortgage-backed securities think housing prices and nationally, and it's important to note that it's all regional, and it's even more that it's loan level when we make investments, but most people in the mortgage market would say housing is going down 3 to 10%. I think most people that are buying home builder stocks or are buying U.S. financial stocks are much more sanguine on housing and that it's going to stabilize or go up from here. So to the extent that those people are right, if housing actually does go up, these mortgage bonds are going to be phenomenal investments, because if you think about subprime, where standard half the people are delinquent, standard assumption is 80% of the people are going to default, and we're going to recover 20 cents on the dollar when they do. If housing stabilizes or goes up, why is 80% of the people going to default when only half of them are delinquent? It should be less than that. Why are we only going to recover 20 cents on the dollar? Why won't it be 25 or 30? And if those things were to happen, these bonds, which we think are going to yield 9 or 10%, are going to yield 20%. So if that scenario comes to pass, these are great investments. To the extent that the economy, muddles along or gets a bit weaker, I think the assumptions that go into mortgage investing, particularly subprime, are more negative than the assumptions that are gone into the investments being made in other parts of the financial markets, which leads me to believe that mortgages are a fantastic risk-adjusted investment today. people have mentioned, the mortgage market's had a lot of great years. 2011 was not one of them. So we're coming off a base where there was severe underperformance in the mortgage market last year. Josh mentioned a lot of the prices of these bonds are comparable, if not lower, to where they were during other parts, pre-Lehman or at the bottom. If you think about, March of 2009, the S&P is up more than 100%. These bonds have significantly lagged that. The bonds are lower than they were pre-Lehman, and other things are comparable to where they were. It leaves us all very excited about it when you combine the assumptions in mortgages, the yields, the possibility that housing will outperform other data and other data that's more impactful on other markets than it is on the mortgage market, whereas housing is more impactful on mortgages. Lead us all to be excited about it. The other issue is the strain on the other side of our business. The strain on the banks leads tremendous trading opportunities, and the opacity of the market leads us to think that there's tremendous ability to pick good bonds from bad. One of the challenges for us in this business is that in the short run, it's all macro, and in the long run, it's all micro. And what that means, a couple different things. One is in the short run, there's too much of these mortgage bonds because European banks are selling. There's $1 trillion of them, what have you. In the long run, as somebody mentioned to me right before the presentation, these bonds are going away. They're not making new ones, although hopefully they'll make some leased-back securities. What are you going to do in the future? And the neat thing about mortgages is that there's too many of them today, and there's going to be too few of them in the future. So that's like kind of a great time to buy. There's too many of them today, which means that we can really use our intense loan level modeling and the investing team doing their work on the back of our loan level model to suss out which of these to buy. The challenge is that you'll find that in the short run, getting back to this theme of in the short run it's macro and in the long run it's micro, we'll see a bank will come to us and say, we bought 10 bonds, we bought these 10 bonds recently from a European bank, we want to sell them all at 40 cents. So we run our models, we do our analysis, and we think 3 of them are worth 50, 4 of them are worth 40, and 3 of them are worth 30. So obviously we buy the ones that are worth 50. Now let's assume for a moment, and maybe it's a big assumption, but let's assume we're right about that. Well, first of all 10 of these bonds will trade within the next week or two at around 40 cents, which means, either some people aren't as diligent as we are, or they just have a different view. And maybe they're right that the ones that we think are worth 30 cents are worth 50, and we're wrong about the ones we buy. But assuming we're right that the ones we think are worth 50 are worth 50, the next few months, those 10 bonds will be marked the same by the street. So that's all macro. We bought ours at 40, and they're going to be up or down next month the same as the ones that the other fellow bought at 40 that we think are worth 30. It's going to take many months for it to prove for the delinquency rates of the ones that we buy to be better or not than the ones that we passed on. But it gives us, the ability to pick out, because there's so much of it today, to be very micro about exactly which ones we buy. And over time, we think that'll bear itself out. But in the short run, it's a macro game, and that's why one needs to use the hedges that Josh and others employ.
Great, thank you. I just wanted to, before we open up to the floor, I just wanted to ask a quick question. It's more of a structural question about the way that you all think about managing money along with LPs. And because I think there might be some nuances here. Maybe start with Josh. In terms of investing alongside your investors, et cetera, how important do you think that is, and how do you feel about that?
Well, extremely important. In terms of interest alignment, are you along those lines? We have put substantial amount of money. Greg talked a little bit about what it takes to be an effective mortgage investor, and how there's very few people. You need a certain scale. You need to be at least a few $100 million in a hedge fund in order to really afford the data and the analytics and ultimately the personnel to get into the loan level analysis that goes into mortgage investing. And for us, we actually spent 18 months before we actually managed a single dollar of other people's money doing all of this. Spending our own capital, building what we view as best-in-class research and analytics to analyze these bonds. And so we spent a lot of money there, and obviously we're invested alongside our investors as LPs. So I think it sort of speaks for itself in terms of the investment in the business, in addition to the typical investment that you associate with a hedge fund, where you stand alongside your LPs.
Okay.
I'm known for arguing the other side of this thing, even though I do invest alongside my LPs. I invest alongside my LPs because we do pretty well, and I trust myself and I trust the people who work for me. But most of my investors are institutional investors. They're pension plans, they're insurance companies, they're university endowments, and so forth. And they have very, very different utility functions than I do. The argument that you should have skin in the game is an argument that says that you'll be more careful with your investors' money if your own money is at risk as well. As far as care is concerned, and I agree about this, I think that I am as concerned about my own money as I am about my investors' money. Sometimes I think it's probably not true, since outside of the money that I manage of my own in our own funds, I feel I ought to pay more attention to some of the other stuff that I do, but I kind of don't. But in any event, I think it's probably true when it comes to standard of care. On the other hand, if my risk tolerance is, given my position as a human being, I have 2 young children, and I'm in my 60s. My utility function is probably very different from XYZ University's Endowment Association's utility function, or the pension plan of the public employees of the state of Fredonia, what their utility function is. And so I have to be careful, I would think, not to allow my own interests, as determined by my own utility function, to obstruct the interests of my investors. So I don't believe it's as clear-cut as many people do. Perhaps there are some, if you're a high-net-worth investor and you're investing with a high-net-worth manager, and pretty much there's no institutional component, and you're roughly the same age and you have the same other demographic considerations, it makes a lot of sense. I'll agree about that. But I don't think it's something that one can just assume.
Okay.
Yeah, I think Don has some interesting perspective on that. I mean, ultimately, fortunately for us, or for me, a significant amount of my money is in the fund, and my view on what I want the returns of my money to be is the same as what we represent to our investors that we're trying to achieve. So we're trying to achieve low to mid double digits returns with an emphasis on minimizing the downside through hedging. So we think that in really bullish markets we'll do less well than others, but hopefully in negative markets we'll do better than others. And so we're in that our money's in the fund as well, but we're investing the money not with an eye towards the returns that we want in our utility function, but the returns that we've represented we're trying to achieve, right? So I may be more or less risk averse than the fund, but I'm not managing it based on what if I want less risk than the fund has, then I should probably keep all of the money I have that's not in the fund in cash. And if I want more risk than the fund has, then I should take the risk outside of the fund. And that's how we don't really see there being any conflict. Our money we're managing the money and for the goals that we've set towards investors, and our money just happens to be along with.
Okay. Excellent. Let's open up to the floor. Let's see. We've got a bunch of questions over here. Let's start over here.
Josh, specifically, I've heard numbers that European banks own 25% of the non-agency $1 trillion face value market, the RMBS market. You mentioned that you're not concerned about those banks selling, even in a big downturn, Greece, exit. Why don't you think that market will sell, the bank market?
Well, I think it's a question of scenario analysis. So when I assign probabilities, first start with what's the probability that we get at a Europe event, and we try to hedge a Europe event. And when we think about the kind of leverage that we get out of our hedges relative to the amount of selling that we'll see I think your numbers are approximately right, that in the low 20s in terms of the percentage of the $1 trillion market. When we look at it and we think about what they'll sell first, we just don't think that structured credit is going to be high on the list in terms of the order of priority. Now, that's not to say...
Why is that, though? Why, I heard you say that before. Why would that be the lower priority?
Starting with valuations, I mean, we're not the only ones in the room who feel that this is a cheap asset class. You know, I think there's going to be a number of other things that they could sell before they start to come to this market. Now, we do need to be concerned because, you know, the liquidity of this market's improved dramatically. So if there is a perception of liquidity, you know, one of the things that got the main lane auctions re-energized was a perception that there was a lot more liquidity in the RMBS market this year compared to last year. And that perception turned out to be accurate. Interestingly enough, more supply this year fomented more demand. I mean, you actually had a lot of large players who are attracted. You know, they're different than us in the sense that they don't do this on a daily basis. And for them, it's a pain to sit there and analyze each and every bond. But if somebody says, you know what, there's an opportunity to buy several billion at a clip, and it's a portfolio opportunity. Now, it's not necessarily going to trade as cheap as the bonds that we're accumulating slowly on a daily basis, but for them, it's a much easier transaction. They can do, you know, a lot of times these are large blocks in terms of the individual bond names, and then the overall transaction is very large. That brings out demand. That brings demand from other areas, and that's what we saw this year with the main lane 2 auctions compared to last year. So, not saying that we won't see the supply, but I think you can put some reasonable probabilities on it. You think about what does it cost to hedge some of that scenario, and then you think about what's happened this year in terms of having large portfolio trades, attracting big players, not just in the alternative community, but I mean, the insurance companies are back. The insurance companies are struggling to find yield in their portfolios. They've essentially re-engineered their ability to buy these assets. You know, the insurance companies used to be constrained by the S&P and Moody's and Fitch, and they said, why are we listening to these people? They got it so wrong in the last crisis. So they've come up with their own rating system, and you know, they basically have independent ratings that are created by a group at BlackRock and a group at PIMCO, hopefully independent. But fundamentally, that allows them to come back to the market. I mean, in the maiden lane 2 auctions, AIG is buying the same bonds that they ultimately had to sell that created the reason for maiden lane. So it's not just alternative community coming in. It's very large buyers who see the value in these assets, and I think you could actually get more selling, produce almost counterintuitively more demand.
That's the question. I was wondering if you could each comment on what's called 1994 risk. So Don's latest fund is predicated on at some point in time rates going up, and let's say that happens in 2013. The set of circumstances, so home prices should be stable, the economy should be doing better, and the Fed decides to do measured rate hikes 8 or 10 times in the same year. In 1994, that crushed mortgage hedge funds. How do you think about the balance of, yes, there is value in terms of credit, but if rates go up, prepayments slow down, the nature of the bond, the fixed loan bond itself goes down in value. So how do you think about that as a risk?
I can tell you that, I mean, we approach it from different perspectives. Each of our funds has a separate strategy. And each strategy is fairly well defined. I mean, there might be slight tweaks to it here and there, but they're well defined. So we hedge against rates because rates affect prepayments to a greater or lesser extent. We hedge against a bunch of other things as well. So for most of our funds, the pure effects of rate changes would be relatively minor. On the other hand, rates also can affect spreads. So, for example, you mentioned prepayments. Higher rates predict, everything else being equal, lower prepayments, and that would tend to bring spreads down. However, I mean, they would make them tighter. There's also some other issues. It's been one of the things that's been mentioned earlier is how, whereas in 1994, mortgage hedge funds were an exotic breed. And one of the interesting things about it, and we've done some studies of this, is that as an exotic breed, we tended to all do pretty much the same thing at the same time. The differences between my funds and some of the others were if we were buying a particular kind of mortgage-related asset, we would be 50 or 75 basis points apart in what our hurdles were. And when you have a market in which you have a very limited number of players, on one side of which there's a prop desk or dealers, and the other side everybody is bidding for the same things, what you get amounts to wave reinforcing behaviors. So what you'll tend to see is people bidding prices up and up. Returns start dropping because this is fixed income. Leverage is available. So in order to achieve hurdle or target returns, one levers more and one keeps seeing prices going up. And then finally, somebody hasn't managed their liquidity properly. They start falling apart, selling, and you start down the other side of the wave. But what that predicts are high amplitude, low frequency, long waves, right? If you measure risk at anything less than the full wavelength, you're likely to see risk as measured in terms of volatility. You're going to see relatively low volatility until some catastrophe happens, and then instantaneously you see high volatility. So I've spent years and years telling and talking to investors about trying to answer the question of why mortgage funds blow up. And the 94 type experiences were an example of that. And the answer is almost never has anything to do with the specifics of mortgages. It tends to have to do with some kind of liquidity crisis. In the case of 94, what precipitated it was this big movement in rates. Suddenly, somebody with too much leverage and too little understanding went, kapowie, and then you had effectively a localized financial panic. The market now, with different kinds of players, multi-strategy players, rates players, macro players, all involved in it, distressed players all involved in it, tends to predict less high amplitude, lower amplitude waves with shorter wavelengths. And that means you're also likely to see more volatility, short-term volatility. So you would expect, standard theory would tell you that equilibrium spreads under those conditions should be higher than under the conditions I described before, where you have low apparent volatility, even though you have, over a longer period, high volatility. So we don't think that mortgage funds blowing up when rates start going up is as likely as it might have been years ago, partly because there are more mixed approaches to what people are buying mortgages for.
Yeah, I mean, I would add to that. I think that's a lot of it. But, the issue in 04 was, you had the inverse IO trade sort of blow up, and that filtered through to other things. When you think about the mortgage market today, while
They were inverse floaters.
Inverse floaters. Now they're inverse IOs, talk about more leverage, but they were inverse floaters back then. Today, a lot of the mortgage, like a bigger percentage of the mortgage market is not related to agency and AAA CMO derivatives, but rather this sort of recovery trade. And if you think about the non-agency mortgage market, it's almost exclusively LIBOR floaters with a 50-cent average dollar price. LIBOR going up particularly because you pointed out if LIBOR goes up because the economy is getting better, could actually be a double win for the main things that Josh and I buy and some of the things that Don buys, where our coupon is, we have a 50-cent bond, so it's going, the current yield of that bond goes up at 2 times LIBOR. And if the reason LIBOR is going up is because the economy is getting better, not only will the assumptions that go into generating those yields become more benign and favorable to the price of the bond, but the carry of the interest received on the bond will go up. So actually, in a 94 event, a lot of the things that some of us do will do phenomenally well. You know, the inverse IO trade may get crushed. It may do okay if prepayments don't increase at the same time that LIBOR is going up. So the inverse IO, certainly the carry will go down, but maybe that will be okay. Maybe it won't, because maybe those people, if housing is going up, more people will move and prepayments will go up. But the non-agency sort of distressed credit trade, and to Don's point about how diffuse the market is, the mortgage hedge fund universe is much more diverse in terms of the angles people are playing. But the big thing that people talk about, or maybe it's because I'm a solipsist and thing that I focus on because we don't buy agency derivatives, but I think that the big thing that when people talk about mortgages, the main thing they talk about these days, or one of them, is this non-agency recovery trade. That would not be hurt by rising rates if it was accompanied by rising rates and an improving U.S. economy.
There were a couple more questions. Maybe in the back here, yeah.
To what extent do each of your strategies rely on leverage, and just generally speaking in the markets that you invest in, are you seeing higher leverage, a trend of higher leverage or lower leverage, or no change?
Start with that. My history in the mortgage market goes back to the early 90s. I remember that 94 event vividly as being one of the many times the mortgage market suffered. It seems like every 5 years there was a problem in mortgages in my career. And myself and my longtime partner, Jeremy Primer, I worked with at Goldman, who's now with me at Tilden Park, we've successfully navigated the variety of distressful markets, both on the agency side and the non-agency side in mortgages over the last 20 years. And one of the central tenets, that it's easy to say, but not everyone does, is to not have too much leverage in the mortgage space. To have dry powder when other people are doing stupid things and ultimately getting over their skis is a huge boon. And that, whether that was 94 or 98 or the early 2000s or ultimately, the 06, 07, 08 crisis, leverage is a fundamental concern, a very central issue with any of these strategies. Now, on the when you talk to an agency guy, he's going to have a different number for leverage than a non-agency guy. Some of these agency strategies or the agency REITs, for example, still have very high leverage over 10 to 1 in many cases. In the non-agency space, I think that the typical hedge fund that's using leverage is really ranging from anywhere from, on the non-agency side, is ranging from maybe no leverage at all to maybe borrowing up to 100% of the equity of their book. And we're kind of halfway in between there, where we basically have about a half a turn of leverage on our book. And we think that's the right place to be right now. I will tell you that is far less leverage than we could have. If you think about the amount of leverage that the street, that the banks will provide you as repo lenders, it's been generally increasing in this space. It took a pause last year when volatility increased. Haircuts weren't really increased, but they stopped decreasing, and now it's sort of stabilized relative to where we were last year. But you can consume a lot more leverage in this space if you wanted to. And some of that's just a statement on the fact that these assets are, a lot of the banks, they set their haircut targets based on trailing volatility. This is a space that's been relatively unvolatile lately. You take a month like last month when stocks were down measurably, corporate credit was down. Most of the non-agency bonds on average were kind of unchanged in price. So the volatility of the space has come down a lot, and you could consume a lot more leverage right now. But we think that one of the keys to being successful is one of the hedging aspects that we have to our whole program is if the world gets worse, we do have hedges. At the same time, we're going to lose some money on our longs, of course. But one of the things that I really like is one of the sort of business hedges that we have is when the world gets worse, generally in mortgages, there's a lot of people who get over their skis. And that's when we feel like we can take a lot of advantage of that distress. Last year was a great example. Last year, many of these assets got annihilated. Some subprime bonds were down more than 30% last year. We were up 10% last year. Now, that's a function of hedging, and that's a function of picking the right bonds, but that's also a function of managing risk to a fairly conservative level so that when other people need to come and sell, namely last year a lot of Wall Street was deleveraging, we were there and able to be essentially liquidity providers.
I think we might have one more with our chairman if he lets us. One more, okay, right here.
I wanted to ask you a question about unemployment. If the unemployment rate stays sustainably high, it's 8% for a very long period of time, it's 8%, but call it higher than normal, how's that going to affect your strategy? Because one of the dilemmas with high unemployment and negative equity, you don't have employment mobility. Before you had a person loses their job, they move down south. Well, if you have negative equity in your house, you can't.
I interrupted, I'm sorry.
That was the question, and also the rent-to-own question. You've seen home builders go into that building. Is that scalable?
To answer the latter part, it's an interesting question. I mean, we're investigating this. One of the things we tend to do is we tend to look at things, investing as kind of experimentation. You design your experimental structure and then you try different things. And we're trying to enter this space that you're talking about. And we're concerned about both the questions that you raised, both parts of it. First of all, the employment question and labor mobility. And the second had to do with the scalability of basically rentals and like that. To answer the things in reverse order, I think it's one way of thinking about this has to do with the scalability dependent upon the need to maintain a house, and when the occupant is the owner, the occupant maintains it. If you think about this in terms of some standard theories, you'd say you live in your own house. Suppose you only have one house. You take care of it. You mow your lawn. You call up the plumber. You call up the electrician, blah, 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 if things go wrong, right? You make sure your taxes are paid, or if you have a mortgage, maybe your mortgage company, you put an escrow payment on your taxes and your insurance, and they take care of it. But if you calculate the economies of scale you have, the obvious economies of scale are zero, because you only have one house. Suppose it turned out that the curve of economies is actually some sort of step function. So you don't begin to achieve economies of scale until you have at least 100 homes that you could take care of for one person. Make it 10. I'm kind of lazy, so maybe 10 for me, or 3 before I achieved any economies of scale. At that point, it should be cheaper per house than it was before. So, at least with respect to maintenance, theory tells us it should be possible to achieve savings over what an owner has to expend to maintain their house. In terms of construction, I talked about those houses in Levittown in 1947. Those houses were built in a way that made it possible for them to be rented. They had very small lots. They were relatively small houses. For the time, they were. I mean, by today's standards, they were tiny. But they were built in a special way, and it was possible for them to be rented instead of owned. So I think there's a question of whether or not build to rent turns out to be a scalable way of doing things. As far as labor mobility is concerned, having your mortgage underwater is undoubtedly an inhibition for moving. On the other hand, if you actually need a job, you have no job, the chances are you've you're either on the verge of exhausting your ability to pay your mortgage anyway, so you're going to be tossed out of your house. If you're tossed out of your house, you got to go live somewhere else, and maybe it's an incentive to move. So I think the unemployment question is more a question for people who have jobs but could locate to somewhere else and won't because of their their mortgage being underwater. It's also a problem, by the way, for people in the baby boom generation who have done some kind of new home purchase in the last 10 years or so, or did a cash out refinancing, and therefore their mortgage balance is not lower than it was. It hasn't amortized down to the point where they really don't owe anything, so their house is no longer underwater. But those people who are counting on their home equity as a way of financing their retirement are no longer in a position to do so if they were in that position. And that means that they won't be moving to Scottsdale or South Florida or wherever the hell they wanted to go, right? And that has implications for labor. Because, for example, it turns out that Florida used to require a net population inflow of 4% a year in order to be economically stable. Because they don't have any income tax, they were dependent entirely on the provision of services and real estate to people who are moving there or visiting there. And when that slows down, the whole state's economy slows down, and jobs, disappear. So there are lots of cases in which it's not a direct connection between an underwater mortgage and employment and labor mobility, but there's an indirect connection like the one I just mentioned in Florida.
Tons of great questions. Thank you, everyone. And I want to hand this back to our chairman, but this has been a great panel. Thank you to the panel.
Thanks, Brian. The chair to my right's empty. Bob Aaron has been with us for so long, over 15 years as an underwriter. He's battling cancer, and he's responding to chemotherapy, so think of Bob. I know I do. We're taking July off, and so don't, Larry Bartimer, if you're here, please don't show up at the museum on the third Thursday. And but in lieu of that, we will have a board retreat at the Campfire Club, Sporting Clays. Thank you, Doug. Doug Perkins is our treasurer. He's sponsoring that event. And I do want to, again, say thank you to Mark Silverstein and Ray Gustin on the Best Practices Committee, the Education Committee. We are on the probably the 90-yard line on finishing our latest in the series of best practice documents. We started with portfolio construction, due diligence. Last year was managing complexity, and this year will be avoiding mistakes. So thank you, Mark. It's been a very, very good effort, probably the fastest we've ever done this in. And Don, you mentioned Citizens United, and corporations are people. That Supreme Court said that corporations can make unlimited donations to politicians. Well, I would argue that also LPs, like corporations, can make unlimited contributions to their favorite not-for-profit. So make your check payable to the Greenwich Roundtable, One River Road, in Coscob, Connecticut. And thank you very, very much, Josh, Don, Greg. Good job. And Brian, thanks for putting this together.